Hey gang, Catch Up to 5 listeners. This is a special two-part episode. Number one, we are unveiling our mystery man, Jeff York, who is the Wealthy Custodian because he's an HSA expert. We have HSA Maven, Jackie Cummins-Koski, my co-host on this, and I'm just trying to keep up with them. The HSA is an important topic. It really isn't out there in our FI bubble, and we went long on this one. This is a comprehensive episode. It's going to be in two parts. Today, we're going to talk about tips, tricks, and misnomers of the HSA. And then part two will be questions answered from the audience. So here we go.
I'm over $200,000 now just from doing that for 12 years, doing the family max. So it'd be over $200,000 more than likely.
Just one comment, Jackie, you could do something that I couldn't do in 2008. Invest. Remember, the world is blowing up.
Yes.
So you had the stock market winds to your back.
I did.
Fill
I had
your sales.
Yes, you're right.
I'm not putting you down. I'm just saying that.
No, you're right.
A lot of your growth. I saw your chart. I think like 56% growth, correct?
Yeah. Only 8% of HSA accounts have a portion invested. Only 8%. So the majority of people are not investing in their HSA. And so this is the big difference here.
That's a shocking number, really. And I guess that 8% is the FIRE community.
Yeah, I was about to say the 8% is the FIRE community. And the funny thing is, I've been tracking this for, I would say, probably the last 10 years. So about 5 or 6 years ago, it was only like 4%. It was even smaller. So we're talking about this just to make sure everyone knows that you can invest in your HSA.
Your body is just like any other use asset, like a car or a house. It wears out no matter what you do and how well you take care of it. And I know, as sure as the sun's going to rise tomorrow, I will be needing health care when I'm in my 80s.
So you're looking at it as like self-funding your long-term care insurance, right?
You got it. You got it. But
Okay.
I've been told by other financial planners, don't use the HSA for long-term care. Go for, what is it on the taxes? If you're adjusted, if you spend 7.5% on healthcare, you can get a deduction basically.
Welcome to Catching Up to 5, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together. Welcome to Catching Up to FI. I am Jackie Cummins-Koski, and I'm here with my co-host, Bill Yount. Bill, how you doing today?
I'm doing awesome. We got a special episode today because we don't know that anybody's done one like this, and we have two experts on the topic. So I'm going to sit back, relax, and let you guys have the spotlight because you guys are the mavens, the gurus, and we hope this really not only entertains our audience, but gives them information they might not have had before.
Yeah, that's right, Bill. And I think as we were preparing for this, you even said you picked up a few things, and we're just continuous learners. So today we are going to talk all about health savings accounts, HSAs, and we're going to talk about who's it for, how the HSA eligible and high deductible plans work. We're going to talk about accumulation in the HSAs. We're going to talk about managing them, investing them, and then finally drawdowns and estate planning issues. So we're going to go from A to Z. But before we do that, Bill, you got a few shout outs for us.
Yeah, I sure do. We'd like to have a review of the week, a charity of the week, and a podcast shout out of the week, sort of a new thing for us. So the review of the week comes from an anonymous person that said, I listened to a number of financial and retirement podcasts, and your, by far, is the podcast that most resonates with me. Thank you, and please keep up the work. Thank you for that. That really does sort of warm our hearts and give us the juice to keep on going. And the charity of the week is special to me because it's the Grand Teton National Park Foundation and the Teton Rangers. A good friend of mine, Jim Dolly, the white coat investor, had a really bad accident while rock climbing and was airlifted off the face of a mountain. And these guys essentially saved his life. So we encourage you to take a look at this charity, and maybe you want to donate as well. Now, as far as the podcast shout out of the week, we had Jesse Kramer on the show recently, and you'll be hearing this episode in the near future. And he has a relatively new podcast called The Best Interest. And he takes complex topics and distills them down to simple bites. So we really encourage you not only to listen to us, but to add to your queue Jesse Kramer's podcasts. Okay, Jackie, why don't you introduce or reintroduce our guests?
Yeah, and we love to share great stuff and we love to share the love. So as we mentioned, we're going to talk all about HSAs, health savings account. Now, to really do this conversation justice, we brought in our good friend and HSA genius, Jeff York, or better known as the Wealthy Custodian. Jeff was our guest on episode 74 and 76. And we loved him so much that we just had to bring him back on this topic because he knows so much about it. He's going to talk a lot about the history of HSAs and obviously his firsthand experience. So in case you didn't catch him on those shows, here's just a quick recap. He reached millionaire status, achieved financial independence, and retired early. But the jaw-dropping fact is that he did all this while working as a public school custodian in California. His highest income was just $21 an hour, which comes to about $44,000 a year. So, and if you're trying to do the math and where that falls, basically, according to the Federal Reserve, the median household income in America is around $70,000. So he did it on a lot less. So he's super modest when it comes to wealth, but he loves to teach others. And he came on today to talk specifically about HSAs, and we're excited to have him. So Jeff, you're welcome to the show.
Well, thanks for having me on, Jackie and Bill. It's a real pleasure to be back.
Yeah, welcome back. You're becoming a correspondent on the show because your breadth of knowledge is extensive, and I'm sure there's other topics that we'll have to bring you back for.
Well, I appreciate that.
Yeah, we got a lot of great feedback. So before we kick it off, I thought the three of us could maybe just talk a little bit about how long you've had your HSA, how you use it, and maybe your provider and things like that. So everybody kind of knows where we stand with that. So Bill, why don't you tell us how long you've had your HSA and who you're with and how do you use it?
Well, I've had it about 10 years. I got going with it before I really woke up because I was sort of forced into a high deductible plan being an independent contractor and organizing my own policy. And I found it very advantageous. I use Fidelity. I think all of us do. And if you check out the Morningstar article that we'll link into the show notes, Fidelity is probably one of the premier plans that people should consider using. So I'm very happy with it. I have over a six-figure, not over, but a six-figure balance in it. And I invest it in one total world index fund to maximize its growth. So I'm a big fan, but in our hosts here, I am late to the game because the two of you were on top of it much earlier.
I will tell a little bit about my HSA and I want Jeff to go last because his is the most impressive. So Bill, I've had mine around the same length of time as you. Now, I currently do not have a high deductible plan where I can contribute to an HSA, but I started back in 2008. So I contributed for about 12 years. I guess I consider myself an early adapter, even though, again, Jeff has been a little bit longer. I currently use Fidelity, but when I was working, my company used Optimum Health for the HSAs, and my HSA just crossed over $200,000. So that's crazy. And that's, yeah, where's the confetti? Where's the confetti? And remember that I have not made any contributions to that account for the last 5 years since I've been retired. So that's 12 years worth of contributions from me and my employer, and those were family contributions. So I do use it for long-term vehicle. We'll talk a little bit more about that and how others can use it, but I have Fidelity as well. And it's been working pretty good for me. But Jeff, I want to hear about your HSA, how long you've had it, who you use, and how's it going for you?
Well, I had started my HSA in early 2004. We'll go back in history a little bit. The HSA comes out of the Bush II presidency, ownership society, take control of your health care. So the reason why it was, I would say, attractive to me is at that time at the school district up until about 2000, I was on a top plan Plan A, 100%, no deductibles, no copays, no out of pocket. The employer paid for it all. But in 2001, inflation reared its ugly head in the healthcare industry, and the premiums started to go through the roof. So by the time 2003 came out, they were taking about $250 a month out of my paycheck over and above what my employer was contributing. And there was no high deductible plan offered at the time. So when you're making like $10 an hour, $11 an hour, and you're single, that kind of hurts. So when the HSA and the high deductible plan was first offered at my school district, I jumped on it immediately. And I implemented moving on to the high deductible plan. But at my employer, it was not an employer-sponsored HSA. I had to go out and find my own custodian and everything. And at that time, no one really knew what an HSA was going to become. And I invested mine in Wisconsin called Green Bank. And history serves me right, it was just in a cash account. And if I remember right, interest rates were still pretty high back in the early 2000s, and it was basically invested in cash. So that's where it was. And I think at the time, the most you could put in as a single was $2,050. I invested in that. And in 2006, I would start calling Vanguard off, asking them if they would start offering HSA so I could use Vanguard products. And in 2006, I got tied in with health savings administrators. And at the time when I was moving my money from one custodian to them, they didn't have any real good products at the time. So I asked on the phone if they would offer Vanguard products, and magically within a few months, they had Vanguard products. But at that time, they had fees. They had like a $45 a year account fee. I think they were charging like 25 or 30 basis points every quarter. They would take it out of your account, health savings administrators, and then you had the expense ratio of the product you were in on top of that. And so anyways, I had them all the way up until 2019, until I was always calling Fidelity, saying, why don't you offer your own individual HSAs? And then I moved it over to them at the end of 2019. So up until about 2010, I made steady contributions, but from 2010 to 2018, I didn't make any more contributions because you got to remember, I'm now single. I'm now bought a house on $32,000 income. And when you're single, you're paying the full freight of life, the carrying costs. So I didn't do any more contributions into the HSA till 2019. And my balance is about $70,000 right now.
Yeah, that's awesome. And I wanted us to kick it off that way just to see how we're using it. But certainly, since we all save and invest, that is not the only way that you can do it. So I want to go back to the basics a little bit and really just talk about who is a high deductible plan with an HSA for. So let me go ahead and just share. If you're on YouTube, we're going to share some slides, and this entire presentation is really the most comprehensive presentation and podcast episode that you're going to get around HSA. So we're going to provide that for everyone. And if you're on YouTube, we'll show a few of these slides. So right now, I want to share the basics of HSAs. And Jeff, if I'm missing anything, let me know. So you do have to be on an HSA eligible health plan. And I purposely use the term HSA eligible and not just high deductible plan, because not every high deductible plan meets all the requirements for an HSA. So just keep that in mind. So they're almost used interchangeable, but they must meet all the requirements in order to be able to contribute to that HSA. So you do have to be on that plan. So when it comes to who should be on a high deductible plan, Bill, what do you think? Why did you choose an HSA, and who do you think a high deductible plan is best for?
Well, I mean, I think it's really good for young people who are healthy and for healthy people in general. I mean, if you're a high consumer of healthcare and you have to cash flow all your healthcare expenses, it may not be for you. And I think that's one of the things you really got to look at before you dive into this.
Yeah. And keep in mind that typically if you've got a high deductible, your premiums are much lower. So consider that. And then if it's a low deductible, typically the premiums are going to be a lot higher. So you have to look at that in aggregate. And I will include a calculator that will help you determine, you can put in certain factors and determine if it's something that would work for you. You can put in your information. Jeff, what do you think? Who are the high deductible plans or the HSA eligible plans best for?
Well, I agree with Bill that if you're younger, you can leverage your age and your health, your good health, and go onto a high deductible plan. But just remember, if you're going to make that commitment, you need to have money set aside in an emergency fund if a worst case scenario. I mean, if your out of pocket maximum for a single person is $7,500 or $72, wherever you're at, you better have that ready. And if you need to go access that money, you need to be ready to do it. I've personally done it several times in my life already on healthcare needs.
I have a sinking fund for that, or the deductible in particular. And in order to cash flow things, say you go to the dentist and you got a, like my wife who has dental issues, and you got a $3,000 crown, you got to be able to take that on the chin.
Yep. Right. And that's no pun intended, but, but yeah. So I guess that's another point to say that we'll talk a little bit more about the HSA eligible expenses or what you can spend that money on, but it does go beyond medical. Like you can use it for dental, you can use it for vision, you can use it for hearing and things like that. So those are just some things to think about. And obviously that sinking fund could very well be your HSA. Like there's no one way to use the HSA, even though we use it. Ours are for long term and we invest it. You can spend it down each year if you want to. And that's the beauty of it. It's very flexible.
You can use it for tampons.
Yeah, you certainly can. And women's hygiene. And the funny thing is, you used to not be able to do that. And that's why it's a big deal. You would think these feminine hygiene products, yeah, you could always use it. No, you before you couldn't, but now you certainly can. So yeah, we'll go through some other qualified things that we might not think about. So let's take a look at other things that you probably have heard about is that it's triple tax savings. So it's tax-free going in, out, and while it grows. And we'll go into that a little bit more. And this is a little known fact, you guys. A lot of people don't know that if you get your contributions through payroll, you don't pay FICA tax, that's Social Security and Medicare. So that's a nice little plus. Right. So, Jeff, have you ever had anybody get confused about the HSA health savings account versus flexible spending account as far as the funds rolling over from year to year?
Yeah, an individual that I'm mentoring right now, I was explaining that exact concept to her, what the difference between a flexible spending account and how you have to use it. And if you don't, it goes back to the employer. And with the HSA, you get to carry it from year to year. It's yours. That's a big difference I've tried to explain to the individual.
Yeah, make sure you don't get those two confused. The key word with a health savings account, the key word is savings. It's designed where you can save it and roll it over. With a flexible spending account, the key word is spending, meaning it's designed to be spent down every single year. So that is an important distinction.
Can you have both?
You can have both. I actually have a slide that kind of explains how they could be compatible. So you can possibly have both, but remember there's a bunch of different types of flexible spending accounts. Like you can have a dependent care flexible spending account. You can have one that just covers like vision and dental. So it is possible. It is possible. And as we talked about, even though we all save and invest the funds in there, but you can also spend the funds in your HSA. If you say, you know what, I don't want to save it for later. I want this HSA to be like sinking funds for me, or I want to use it each year as I go. That's totally fine. There's no one way to use it. And then the last thing I wanted to mention is that big difference in a flexible spending account and a health savings account. So those are like the basics that I really wanted to kind of tap into and make sure that everyone at least knew those. So let's talk a little bit about, I guess it's so hard to have a conversation about HSAs without talking about the high deductible plans. And we all have experience with that. So I get people asking me things like, so does that mean when you go to the doctor, you got to pay full boat? I could be paying hundreds of dollars and things like that. So Jeff, what is your experience with using a high deductible or an HSA eligible health plan for your normal health care and not touching your HSA?
Well, what first you have to find out is what is the deductible? That's the full amount you're going to pay. And then you need to figure out what the co-insurance is once you reach that deductible amount. Is that going to be, you're going to have 70-30 or 60-40 until you reach your out-of-pocket maximum. You have to kind of dial those numbers in and figure out what that dollar is going to be to you until you reach the out-of-pocket maximum, say like $7,200. So that's how and like I said, when I've ever gone for healthcare, I just pay whatever comes through and send them the money and not touch the HSA because I look at that for future stuff. I don't know if that's a good explanation. But.
Mine is 80-20. And we've been heavy users of it this year because my wife had breast cancer. So, and I've been, and that we had cash flowed everything and hadn't really had to flex our HSA. And I've been very impressed with how it's worked out.
Yeah. So let me just share a little bit of what is actually covered, because I think a lot of people are afraid of having to pay a lot of expenses when they need to see the doctor. So there are some preventative things that are covered, like our annual visits are included, like your wellness visits. Those are included. You don't pay anything for those, right? And then well woman, well child, all those are included. But here's a list of things that are included. You can see this if you're on YouTube, but it's tests. Those things are included. Screenings, vaccinations, cancer screenings, like your mammograms. And I mentioned your annual doctor's visit, but even pregnancy care. And this was something new, Jeff. I wonder if you knew about this, but in 2019, they came up with this where several chronic conditions could be covered before you meet your deductible. And they listed specifically 4 of them: asthma, diabetes, heart disease, and depression. So you do talk to a lot of people about HSAs and these high deductible plans. Do you think that this addition changed some people's minds or made them feel a little bit better about possibly being on a high deductible plan?
I don't know, Jackie, if I would go that far. I think the bigger issue with people is actually having the money set aside. Because my experience at my school site, people had no problems having $8, $9, $1,000 a month taken out of their check through the Section 125 plan. But one of them told me if my husband had to go to the doctor and write a check for $300 for a copay or deductible, they wouldn't go.
Wow.
I found that really hard because people are much prone to have it come out of their check as opposed to have it come straight out of their hand. That's what I see.
That is really important because I see this too. And people will potentially avoid preventative care. The way the government sees it is you become a better consumer of healthcare because you're more judicious when you access the system. But actually, you can find that people let problems really linger until they become critical.
Yeah, you guys bring up a great point because I think the psychological side does matter. None of us, especially you, Bill, as a physician, wants anyone to psychologically feel like they need to delay healthcare because of being on a high deductible plan. So when you are sizing up whether it's right for you, think about the psychological side. When you go to the doctor, are you okay with paying $150 when you're used to paying a $20 copay, right? So just think about those things, and that matters, and your health is paramount. So don't do anything that's going to keep you from it. Now, I noticed, you guys, that it seems like for me, the hardest year was that first year because there's a huge mindset shift when you go from a traditional plan to a high deductible health plan. And I almost dropped my high deductible plan the following year because there was a medication that was not covered. And I ended up paying almost $800 for that because I had not met my deductible. And so we're talking about this now because open enrollment is right around the corner for a lot of people. So we don't want you to just completely skip over the high deductible health plan with an HSA. Consider it, but also think about whether or not it would benefit you by comparing it, give it an honest comparison on how it sizes up to your high premium plan, but your low deductible plan. Positioning it can make a difference, but just know that if you decide to try a high deductible plan, that first year might be a little tough, but it's because it's changed. And remember, you only keep these plans for a year at a time, right? We have open enrollment every single year. So let's go on and take a quick look at, we briefly alluded to it, flexible spending accounts versus health savings accounts. So these are just side by side. And the main differences, I'm going to show all these. For flexible spending, like I said, the key word is spending. For health savings account is savings. Use it or lose it. I'm going to show the screen if you're on YouTube. But the main thing I want to point out is that for a flexible spending account, there are different types. Like Bill, you were asking, can you have both? And technically the answer is yes, you can. It depends on the kind. So Jeff, how familiar are you with flexible spending accounts?
They had one at my work site and I never used it. And I think for you to have an HSA and a flexible spending account, it has to be compatible. And I don't know what the criteria is exactly that makes a flexible spending account compatible with having an HSA. Because I think what the government doesn't want you to do, it's just my opinion, they don't want you like double dipping. They don't want you getting the tax deduction on the HSA and then also getting the deduction there. So that's my instinct. That's my feeling. But I don't know what makes it compatible because I never used the flexible spending account.
I had a flexible spending account when I was at work and our kids were young, and we used it for all the pediatrician visits. And at the time, I remember there was a max of about $3,000, and it's owned by the employer, which is why it doesn't roll over. And as Jackie alluded to in a previous slide, you cannot invest it. It stays in cash. Right. So it's subject to healthcare inflation and inflation in general, but it's not going to be a big impact because it's year to year.
Yeah. And Bill, that's a great point that it is owned by the employer. The HSA is owned by you. You can actually open up your own HSA. You don't have to use your employer ones, although one of the benefits is, as I mentioned, that you don't have to pay FICA tax if you do it through payroll. So here's what is allowable when it comes to HSAs versus FSAs, flexible spending accounts. So you're allowed with an HSA, you're allowed to have a dependent care flexible spending account, a commuter flexible spending account, or a limited purpose one, such as like dental or vision. Now, I feel like out of all of these, you guys, I see the dependent care, like for childcare or for daycare services. I see those offered. So you'd be able to have that. And then there's something called a post-deductible FSA, I guess, once you meet your deductible, but I don't see this very often. I've never seen this with anyone that I have worked with. So the one thing that is not allowed with an HSA, to your point, Jeff, you can't double dip. You cannot have a medical flexible spending account with an HSA. That's when it is no longer compatible. Okay, that's fair enough. Okay. So we're kind of nerds, and I do go and look at the IRS publication that talks about the eligibility checklist. And here's just a quick checklist. In order to open it, you do have to be on a high deductible plan on the first day of that month. And this checklist will come in handy when we talk about the scenarios a little bit, because it can get tricky. You can't be claimed as a dependent on anyone else's tax return, and you can't have any disqualifying health coverage. That's things like you can't be on Medicare and contribute. You can't be on something called the Children's Health Insurance Plan, stuff like that. Also, this comes up a lot, TRICARE. TRICARE is not an HSA eligible plan. So here's just a few more. And I mentioned some of the other things that is considered disqualifying coverage. There's something called Indian Health Service. So these little nuances. So when I use that term HSA eligible health insurance plan, it's because there's some other little nuances that might disqualify you from contributing.
Jackie, quick question.
Sure.
I had heard that there's a last month rule with regards to the first day of the month. Can you tell folks about the last month rule?
Yes, let's talk about the last month rule. So the way that works is, well, you know what, Jeff, I think you got a pretty good handle on that. Tell us what the last month rule is for contributing to HSAs.
The last month rule, if I remember it correctly, is at the very last month of the year, if I'm remembering this correctly, you have to have credible coverage to be eligible for an HSA. Did I get it right? I'm trying to remember. Like in December, you have to have it in place, because what they do is they take your contribution and break it up into 1/12. And if I remember right, you have to have credible coverage at the end of the year, correct?
Yes.
I think you can max out your account, though, if you have it by the first day of the last month.
But then there's the testing period, because then you have to have it moving forward in time, if I remember correctly.
For a year, I think, for a year.
And there you go. There you go with the IRS, because nothing can ever be straightforward. So that's a great question, Bill. So I'll just mention the HSA limits. They already have the limits out for 2025. You knew that, right, Jeff?
Yeah.
Yeah. If you're single, you can contribute $4,300. And if you're on a family plan, the family is you and one other person. Like when I was contributing, I got to do the family plan, and that was just me and my daughter. And then the catch-up, you know what? I think this catch-up contribution has been $1,000 for a long time, right?
It's not indexed. It's not indexed to inflation.
Okay, it's not indexed to inflation.
And for me, in 2025, I can do $5,300.
And that's because you are 50 or 55?
I'm over age 55.
Okay, so it has to be 55 and not 50 like some of these other.
Yeah, you turn age 55. Then you can do that. And the $1,000 is not indexed to inflation. Another thing that I do with the HSA, and I have done with my other pre-tax accounts that I've never heard talked about on the podcast, is if I get a little bit of state or savings on the state tax, if it's going into like a 403B or IRA, or on the federal side, I'll take that tax savings on the federal and state and throw it in there as well, on top of the contribution. Does that make sense?
Tell us a little bit more about that. I haven't heard that one.
Tell us more.
Well, I don't mean to digress, but I never heard anyone talk about it. Like, you know, when you're in a regular 401k plan and you have an employer match and you put your money in and they match up to 5 or 10%, right? So think about it. Say I'm in the 25% tax bracket, federal, and I put $1 in my HSA, right? There's going to be a tax deduction. So that $1 that goes in the HSA is not really a full dollar, because I'm being incentivized by the federal government, not by the state of California, but by the federal government, that what am I going to do with that 25 cents, that tax deduction? What am I going to do with it? Is that going to fall into my regular cash flow? Am I going to put it in another account, or am I going to reinvest it back into the account? So instead of me next year putting $5,300 in 2025, it may not be a full $5,300 out of my own cash flow today, because I'm going to use some of the federal tax savings to make up that $5,300. Like recycle it. I don't know if that makes sense. Did I do it right, Jackie? I don't know.
Okay, well, I mean, it's just a little trick that you kind of do.
Well, most people, when they put money in their 401k and they get a match, and they put $1,000 in, that saves them some federal and state tax, right?
Oh, correct.
Correct. Right. Just like the mortgage deduction on a house, correct? Right. It's not like a credit where it's $1 for dollar. It's a percentage based on whatever your marginal tax bracket is. So what I've done over my life is on the HSA now, since I'm using that again, if it's $5,300, it may not be a complete $5,300, because I'm going to be getting a little bit of tax savings off of my adjusted gross income.
Right. I see what you're saying.
If you're a higher earner, their $5,300 may only really be $4,500, because the difference between the $4,500 and the $5,300 is the federal tax savings that you're getting, because the government is incentivizing us.
Right.
In California, I am not incentivized, because I don't get the $5,300 deduction on my state taxes. I get it on the federal, and then my tax person has to add it back in on my state side. Does that make sense?
Yeah, actually, since you're talking about the state California state specific stuff, why don't we take just a second and talk about some of these weird states that actually don't allow a tax deduction for HSAs? Is California and what is the
New Jersey.
And New Jersey. Yeah.
And then you said there's two others that have something with the difference.
They're a little weird.
Well,
It's Tennessee and Bill, I don't know if you know this, but Tennessee and New Hampshire, they have special provisions around dividend and interest income within your HSA. But for California, New Jersey, you're in California, Jeff. So every other state in the nation gets a deduction for HSAs, just like it is on the federal level, but not California. Why and how does it work?
Well, in 2005, when I started my HSA, I realized, because I used to do my taxes by hand when I used to send the booklets out to go old school. And I realized, oh, the state of California is not going to allow me to have the deduction. And at the time, I didn't realize. I said, why won't they allow that to happen? Well, because remember, California is more socialistic, and I'm not going to get political, but they don't want people like me that are healthy to leave the PPO plans. They want healthy people like me paying the full freight. They don't want healthy guys and gals and young people to leave those PPO plans and move on to high deductible plans, because there's a propensity for people that are high healthcare users to be on the richer PPO plans, not on a high deductible. So California, over the years, there have been, I'm not going to get political left and right, but it's generally the right, has always been trying to pass legislation to make the tax code in California reconcile with the federal. Okay. Right now, they're trying it again. There's Senate Bill 230 that is moving through that would, for 5 years, reconcile the state taxes with the federal, so you would get a deduction. Also, something else I didn't realize back in 2005, and I think I'm a money nerd, I got to report my dividends and capital gains to the state of California as regular income.
That just sounds crazy to me.
I did not do it for years. I did not do it for years until I'm listening and reading something, and I go, oh, publication 1001, page 6 talks about it at the Tax Franchise Board in California. So I have to take this information and share it with my tax preparer. So are you following this? So the word, it's bitextual. It's side of my HSA is the triple, right? You talked about the triple, but not in California.
So I got a question for you, Jeff, not to be political or anything like that, but do you think that will change? Has there been legislation to change that so that California will follow every other state in the nation?
SB 230 was trying to go through again, but there have been several tries over the years. And if you go in and look and who's sponsoring the bill, it's all Republicans. And there is one Democrat supporting it. But you got to realize in our country, it's individualist philosophy. Individualists. I'm the individualist. I have to take ownership for my health care. I have to put money in the HSA. I have to set it up.
I get you. Yeah. Well, those are Jeff's views, and our listeners
those are just my views. But
Jeff speaks his mind.
California does not incentivize me.
Well, since you were a California guy, I just had to ask you that. But so if you are listening from California or from New Jersey, just know that you have some unique provisions. Also, there's slightly different provision for Tennessee and New Hampshire. So let's go back to talk a little bit about that last month rule. So on YouTube, I'm just visually showing this, but we talked about the limits. They're already out for 2025, and the deadline is you get to make contributions through the tax filing deadline of the following year. But here's how that last month rule works. Yeah. If you are eligible to make HSA contributions on December 1st, you can make a full year contribution. But there is one catch. You have to continue on a high deductible health plan or an HSA eligible plan for the next 12 months. And that's called a testing period. Now, who does this mainly affect? This is people that changes plans in the middle of the year. So if you change plans in October and you're on that same plan as of December 1st, an HSA eligible plan, you can go ahead and do a full month contribution. That's a nice little benefit. What you got, Jeff?
I did that in 2019. I'm getting ready to leave my district. It's September 2020. I'm getting ready to leave my district. I'm on a non-high deductible plan. In September, I go on the high deductible plan. Then I leave the district. I made the full contribution into my HSA for 2019. When I left the district at the end of 2020, I went on a high deductible for 3 months, employer plan. Okay. I made a full contribution for 2020. Then in 2021, I went on to ACA, right? When I went on to the ACA high deductible plan, I had to stay on that for the next 12 months moving forward into 2021 to make sure that the contributions I made, I got it kind of screwed up.
We alluded to this before, but let's take a quick check of some of the common things that you can use for HSA dollars, okay? We know about the doctor visits, we know about the prescriptions and things like that, but some uncommon things, okay? You can use it for Medicare premiums. Some people don't know that. You can use it for Part B, Part C, and Part D. You can use it to pay long-term care premiums. And we're going to just show the whole list here. We mentioned vision, dental, and hearing. As we get older, those things start to go. We mentioned feminine hygiene products, legal abortions. If it's legal, then you're able to do it. Fertility treatments, that's been coming up a lot. Expenses and even psychiatric care. So these expenses that you can use your HSA dollars for can go a long way. And the publication that you can use to look and see if something is covered by your HSA dollars is IRS publication number 502. And there's a friendly, I don't know if you've seen this list before, Jeff, but it's hsalist.org. It's a very consumer friendly website where it has everything, where you can check and see if certain things are covered. So we just wanted to kind of go through those just because we know people get anxious about high deductible health plans, but it's so hard to talk about HSAs without giving you some base knowledge of how these HSA eligible plans work. So why don't we get into how you supersize an HSA. This is the fun part, right? If you decide an HSA for or a high deductible plan or an HSA eligible plan is for you and you have access to the health savings account and you decide that you want to save, invest, and use it for long term, how do you grow it? How do you get this big pot of money that some people call like an IRA for your health care? Things like that. So, Jeff, what did you do to grow your HSA to where it is now?
In 2006, I had started investing it at Health Savings Administrators.
What did you invest it in?
Yeah.
I cannot remember exactly, but I know it was Vanguard products. I don't remember exactly what I had it in, but I know it's Vanguard products.
What do you have it in today?
I have it at Fidelity, but I don't use the Fidelity products. I go out to Vanguard and I'm using a life strategy moderate. I think it's 70-30. It's a fund of funds and everything. It's about 13 basis points. And I remember I had to take kind of a haircut to go buy it because Fidelity and Vanguard don't play nicely together. And I think I had to pay like a $75 fee to go in to buy it initially. You
have one fund in there, and in that you have 30% bonds, and then 70% total stock market fund probably is the 70%.
Yeah.
And I look at it like it's a one fund for life kind of portfolio. And it's part of your entire portfolio. But say you wanted to take higher risk in this, and this is a place to take risk probably for you want growth. You could put your small cap value in there and that be part of an allocation to small cap value. You could, I have it in a total world stock fund. Jackie, I'll out her here. She's the growth girl. She has it in VUG, which is the top largest 300 companies in the US.
The Vanguard Growth Fund.
Yep. And so I don't think you want to keep it in cash unless you're planning on using it. I don't think cash is, with this supersizing concept, that's just not the way you want to go. And people, it's just like with a Roth IRA. You can think you can contribute to it, but you got to remember to invest what goes in there. You can't forget that piece. And for example, in my Roth IRAs, I do the same thing. I want to supersize them as well. And I stick to one fund in there and look at my allocation globally as opposed to, and some people will say, oh, I want to have stocks and bonds in there and stocks and bonds in every account. But I don't know that that's necessarily the right way to do it. What do you guys think?
Yeah, well, we don't want to give specific investment advice, but I think it's reasonable to say if you are using it for the long term, make sure that your investments match that long term horizon. So if I had to like boil it down to like three main things on how I supersize mine and how someone else could if they wanted as a long-term play. The first thing is maxing out the annual contributions. Like some people that I talk to, they will take the employer contribution and that's it. They're not really contributing to it or maxing it out. But if you're able to max it out, again, you've got all those tax benefits, but do it through payroll and you don't even have to pay Social Security and Medicare tax, but max out the contributions. Remember, family is just you and one other person. So it could be, if your household is, let's say, you and your spouse and 4 kids, well, you and one of the kids could be on the family plan and maybe the rest of the family is on a regular plan. So you can almost split things if you want to. But if you're able to max out those contributions, that's a big piece of it. And I'm pretty sure, Bill, you've been maxing yours out every year.
Oh, yeah, absolutely. One of the first things I do, it's like top of the waterfall.
Right. Yeah, that's the top of my. And Jeff, you were maxing it out each year?
Yeah, starting in 2019. But from 2010 to 2019, I didn't do any.
Okay, see, that's why you're behind me and Bill. No, I'm just kidding.
Well, I mean, Jackie, have you ever calculated, say you use VUG, say you use the total stock market index and you started in 2004 and you had sort of the average returns over that time, what would be necessarily your balance today?
See, that is a nice little case study. I came close to doing that, except I didn't start until 2008. So I'm over $200,000 now just from doing that for 12 years, doing the family max. So it'd be over $200,000 more than likely.
Just one comment, Jackie, you could do something that I couldn't do in 2008. Invest. Remember, the world is blowing up.
Yes.
So you had the stock market winds to your back.
I did.
Fill your sails.
Yes, you're right.
I'm not putting you down. I'm just saying that.
No, you're right.
A lot of your growth. I saw your chart. I think like 56% growth, correct?
Yeah. Well, that growth, definitely the wind was at my back. And not only for what I had in my HSA, but in all my other accounts, because that happens. I'm no genius over here, but that coincidentally happened. 2008 was the time where I started most of my heavy investing. So that absolutely had a lot to do with it. So the next part, you guys, is that we have all implemented this. Again, you don't have to do it this way, but we're talking about supersizing your HSA, and that's paying out of pocket for your medical expenses. Bill, you mentioned the sinking fund or having some kind of fund so that you know you can cash flow those expenses. Now, I got a question for both of you guys. Do you guys hold on to your receipt to be able to reimburse yourself later?
Yeah, this is an important part of the HSA. I'm sure we'll get into it in your presentation again later, but I have a whole file. Now, you're supposed to do it digitally. I mean,
yes, please do it digitally.
I have a file folder of all my paper receipts, and there's some big ticket items and there's small ticket items. But then when I get an unreimbursed expense, I have an email folder for it too. I don't have a Google Drive full of it. I'm sure you probably do because you're much more organized than me. But yeah, this is an important one. And tell them why, Jackie or Jeff. Tell them why, if you say these receipts, what you can do with this.
Jeff, can you believe that Bill has a folder of printed receipts? You're kidding us, right, Bill?
No,
well,
I'm not.
I'm getting in line with him because I have the same thing.
Oh, God.
No, I don't have a Google Drive and they're not all scanned in. I got a file folder.
Well, my suggestion for anyone that wants to implement where they are incurring expenses and they want to hold on to receipts to reimburse themselves later, digitally is probably better, even though Bill and Jeff doesn't do it that way. The main reason is that the print comes off and who's going to keep up with that? So I'm low key though. I just have a digital file folder in my email that says HSAs and it goes in there. So the reason for this is that these expenses will start to pile up. Over a 10-year period, you could have thousands of dollars worth of unreimbursed expenses. and you can cash those in anytime you want. You simply file it with your taxes for that year and you take out the appropriate amount that matches your receipts. Now, I have done this, you guys. Last year, I decided I don't want to keep up with receipts anymore, even though it's digital. And I cashed myself out. I think it was about $3,000. Luckily, I didn't have a whole lot of expenses, but I decided now I'm retired. So I'm going to start taking money out of my HSA to take care of my expenses. But it was kind of nice that I got to take that big chunk out. I had the appropriate receipts. I just didn't want to keep up with them anymore. But certainly some people could have significant receipts and they can decide to reimburse themselves at any time. There's no deadline to reimburse yourself. Now, I think the biggest piece for all of us is that we invested the funds in the account. So, Jeff, I'm curious, did you know from day one that you could invest the money inside your HSA?
Nope, because at the time in 2004, there wasn't any options, if I remember correctly. It wasn't until 2006 I started investing in it. But I knew that's what would happen eventually. I could see in the future what would be. And
yeah, because you were there from day one and they didn't have investment accounts. So, Bill, did you know from day one that you can invest the funds in your HSA?
I can't remember exactly. I know I had at least a portion of it in cash. It's a good question. And I think today it's almost a no-brainer. But
Right.
I think I had more of it in a spending account when I was with the HSA Bank. And I mean, when I started this, I hadn't woken up financially and wasn't an investor in a forward-thinking sense. So I don't know, but I know it wasn't 100% stock index funds.
Well, you guys have figured this out, but you know what? I did a little research around this, and Jeff, I don't know if you knew this, but only 8% of HSA accounts have a portion invested. Only 8%. So the majority of people are not investing in their HSA. And so this is the big difference here.
That's a shocking number, really. And I guess that 8% is the FIRE community.
Yeah, I was about to say the 8% is the FIRE community. And the funny thing is, I've been tracking this for, I would say, probably the last 10 years. So about 5 or 6 years ago, it was only like 4%. It was even smaller. So we're talking about this just to make sure everyone knows that you can invest in your HSA. It doesn't mean that you have to use it that way. But for a lot of people, the true value of a health savings account is the fact that you are able to roll it over from year to year and invest the funds. So if it's a long-term play, you definitely want to have it invested. We talked a little bit about what ours is invested in, but that's going to be up to you. But think about your time horizon and things like that and how you want to use it. So we talked a little bit about saving receipts. That's a key piece that was considered sort of an advanced strategy. When you're ready to cash it out, you can spend the money on anything because you've already incurred the expenses. But Jeff, what other bright ideas do you have as far as using an HSA? Are you doing anything unique or different that would be helpful?
Well, next year I'm going to implement a strategy, but I'm going to take it one step further. You know how you have the one-time option of taking your contribution amount out of your IRA and transferring it over to your HSA? It's a one-time. I was thinking about doing that, but I'm going to do IRA to HSA conversions. I know is IRA to Roth conversions, but I'm going to be doing IRA to HSA conversions. And you're saying, what is Jeff talking about? Well, my strategy is next year I'm going to turn 60. Woohoo! And right now last year I moved all of my 403b7 into an IRA at Vanguard. So next year, instead of using the $5,300 out of my cash flow to make my contribution in the very first part of January, I'm going to take a distribution out of my IRA because I'm age 60. So there's no 10% penalty. It's going to go into the HSA. I'll get the federal deduction. So that'll wash part of the distribution away. But I'll still have to pay tax on the $5,300 to the state of California because they don't give me a deduction for my HSA contribution.
So when you are over 60, so you can do it. It sounds like you're doing it in the 2 steps. Now, when you do this formal transaction.
I'm not going to do the formal one. I'm not.
You're not okay. I thought.
I'm
so.
not.
Okay.
I'm sorry, Skip. I'm not going to do the formal one because I don't feel that Vanguard is educated enough to get it over to Fidelity and then code it properly. No offense to Vanguard.
I see what you're saying. So let's explain that to everyone.
Okay,
so
okay.
Because you're over the age of 60, you're not going to pay a penalty. So you're simply doing a two-step transaction that is really not a transfer. You're actually taking a pot of money from your IRA and you're putting it into your HSA. Okay.
Yeah, I'm taking a distribution.
You're taking a distribution.
Just like if I wanted to go put a down payment on a car or something, but I'm going to put a down payment into my HSA for my future 80-year-old self. That no matter how well Jeff takes care of himself in Redding, California, he's going to get old and I'm going to need health care.
So I want to point out something, Jeff. So you think very intuitively, and there are maneuvers that you can do just by stepping through the process. But when people are talking about this one-time IRA to HSA transfer, there is no age limit for that. So why don't we talk about that a little bit? I guess the formal term, Jeff, if you're using this, is a trustee to trustee transfer. They don't allow rollover. So you're allowed to move money from an IRA to an HSA, but there's a lot of gotchas. Okay. So, and I used to think that this was really a big deal. I don't know that it's that big a deal. The biggest reason is that you can only do it once and you have to be on a high deductible plan and able to contribute to an HSA, and you can only do it up to the maximum contribution for that year. So I wanted to kind of list the pros and cons. So here are the cons. Again, only once in your lifetime. You have to be on an HSA eligible plan. And here's this term again, you guys, this testing period. So when you do this IRA to HSA transfer, you have to continue being on an HSA eligible plan for the next 12 months for the testing period. So if you have an inkling that you're not going to be, you might not want to do this.
Another way you can do it too is you could go IRA at Vanguard, the 5,300, transfer from custodian to an IRA at Fidelity, and then tell Fidelity, now convert that IRA to my HSA for a contribution for that year. That's another way of doing it.
Yeah. And you got to remember also the age. So the ways that you do it sort of in a roundabout way, if you're over 60, then yeah, that might work. But I don't want anybody to get into a situation where they're paying a penalty or anything.
It's kind of like a backdoor Roth over 60.
Yeah, exactly.
Nice. Very creative.
Very nice. Hey, we're thinkers over here. Yeah, we're thinkers over here.
I'm thinking over here.
Yeah, he's thinking over here.
I see the wheels are spinning.
Yeah, and I see your forehead wrinkling up, so I know that you're really thinking.
But Jeff, you talked about conversions. This is a one-time thing. Were you intimating that you were going to do it more than once?
Yeah, I'm going to do it for age 60, 61, 62, 63, and then part of age 64, because I learned that when I go on Medicare in April, or when I turn 65 and on my birthday, my 65th birthday, there's a retroactive period on the Part A. So I won't be able to make a full contribution into my HSA when I'm 64 years old. So isn't that another lovely gotcha in the life?
So this is a window for Roth conversions, basically?
It could look a lot like a Roth conversion, though, if you kind of think about it, because remember, HSA dollars, they're tax-free going out. So again, the transfer that we're talking about that formally falls under the HSA transfer, you could be any age to do that. What Jeff is talking about is that, I mean, that's like the advanced PhD class that he started to do some different things.
It's piled on higher. I can grant you that.
But Jeff, you're actually educating me. I didn't even think about that because I was thinking about the confines of this one-time IRA to HSA contribution. But once you're past that 59.5 penalty, you've got a new window of opportunity to do some things that you wouldn't want to do when you're younger, where you have to pay the penalty because it might not benefit.
I could have done it this tax year. Because that would have been 59.5.
Yeah. When'd you turn 60, Jeff? When's your birthday?
2025, April. So
okay,
I'm going to do it. And I always fund my HSA and my IRA and all that at the very first of the month, the first of the year, because you want all that time for it to grow. Right. It's like planting your seed early.
That's a very important thing. A lot of people dollar cost average into this. And if you're able, number one, you have your sinking fund for healthcare expenses. Number two, you pre-save for your HSA contribution in the first week of January, because as Jeff said, that gives you 14 months of growth. This is a lump sum approach as opposed to a dollar cost averaging approach.
Yeah, let me mention this to you guys as a corporate girl. And I know most employers do it this way. They won't even let you put in a lump sum when it comes to HSAs. They will only allow, my company will only allow it, and almost everyone I've talked to and looked at theirs, their company will only allow them to make contributions on a per pay period basis. Now, they may lump sum the employer contribution at the beginning of the year, but even those are starting to be spread out. So your company or your employer may or may not allow you to put in the lump sum at the beginning of the year. Many of them don't, but just keep that in mind. You might not have a choice. And I wouldn't want you to give up the payroll deduction contribution tax benefit where you don't have to pay Social Security and Medicare tax, because if you don't do it through payroll, it'll just show up on your taxes and you don't get that payroll tax deduction benefit. So just FYI on that. Bill is self-employed technically, and Jeff, you were able to do some things on your own. So just FYI, look at your employer and see what they allow.
And just as an aside, I do the same thing with my Roth contribution for me and my wife. I mean, I pre-save for that.
Now I do that as well.
Dump that in the first of the year as well.
Yeah, I do it where I have control. So when I used to contribute to a Roth, then I would do that at the beginning of the year.
What I used to do with my employer that drove payroll crazy is I called it extreme paychecking was my term.
Oh, I remember you saying that.
I would pull my paycheck down to $24 net pay and claim zero on all the taxes and front load my 403b7 early in the year and then just live off of savings and that. And then once I got it maxed out, then I would turn the paycheck back on. Does that make sense?
Gotcha. And I heard that you would do that. So that is awesome. Now, so far you might think, I don't think HSA or IRA to HSA transfers are a big deal. So let me just mention a few of the pros. Okay. Remember, it's not a taxable event, and it is a funding source for the year that you choose to do this. So you don't have to find dollars from somewhere else. You're moving it from your IRA. And then the last thing, Bill, I think you alluded to this. You can almost look at this one-time IRA to HSA transfer as a tax-free alternative to a Roth conversion, because once this money gets into your HSA, it's not taxable. So again, because you can only do it one time, the normal way, because you can only do it one time, it's just not that big of a deal, but it is a maneuver that might be helpful. I'm also thinking it might be better to do it after 55, where you can actually have the extra $1,000 catch up, but you do still have to be on an HSA eligible plan. So this is something that you may have heard about. I don't hear about it that much, but there's that one-time IRA to HSA transfer. So that's a fancy little thing that people can do with their HSA, but we might have alluded to a few of these other bright ideas, but let's take a look at them. So Bill, why don't you take the first one? We talked about this a little bit before, but this is a nice bright idea.
Okay, this is like an HSA smackdown among three people.
Face off. It's a face off.
This is a caged fight. Not really a fight, but
it is. See, Bill, you should have been watching for that.
You got all excited. So.
Oh, wow. Well, so our bright ideas for HSAs as we try to wrap this up a little bit, but we have hit you with a lot. So you may want to go back and reference. But as a reminder, this entire presentation will be available for free in the show notes, and you will be able to go through it, reference it or whatever, but it is chock full of information. So Bill, what about this first bright idea?
Okay, we've mentioned this a little bit before, but we'll reiterate it here. Save your records. And then as Jackie does digitally, Jeff and I are old school. And we still have file cabinets, but reimburse yourself anytime in the future, even before you turn 65. You can do this anytime that you need the money, and it will have grown and come out tax-free with these receipts. And in the meantime, invest the funds to allow it to compound.
Yep. And we did talk about that a little bit, but that is definitely worth repeating. Now, this second one I'll talk a little bit about because I was able to do this. I think, Bill, you're actually able to do it. But a person that is covered on your plan that is not a tax dependent can open a separate health savings account and contribute to the family maximum in their own account. This almost sounds unbelievable, but it's true. So an example would be if you have an adult child, that adult child up to 26 may be on your family health insurance plan that's HSA eligible. But if they're not a tax dependent, technically you cannot pay for their expenses out of your HSA. So the IRS has a provision to say, okay, since you can't pay for this person since they're not a tax dependent, they can open up their own HSA and contribute to the family maximum because they are on a family plan. Now, again, this will apply to perhaps an adult child, or it could be a domestic partner. Now, not for married couples, but a domestic partner. So this can really, and let's say, for instance, if it's an adult child, that adult child, they don't have to be the one contributing to the HSA. You can put money in there for them. And so, Bill, you've got kids that are under 26 that is on your plan. Is that right?
Yeah, they're 25, and I just learned about this thing. So this window between whatever it is, 18, 21, exiting college. Again, this is another window for fancy HSA strategies. But I think, Jackie, you did this, right?
I did. And I didn't know about it at first either. But the reason why I learned about it was because I wanted to pay for some of my daughter's expenses. And I was looking something up and I'm like, oh, I can't do that anymore because she was like 22 and she was no longer my dependent. And then I saw this little provision. So my daughter, too old now, she's like 28, but when she was done with college from 22 to 26, I could have maxed out her HSA to the family maximum and maxed out my own to the family maximum. Now, I didn't have the big bucks, so I couldn't do that every single year, but I did start a little bit of a HSA fund for her separately. So yeah, that could go a long way. And in this presentation, we have a scenario that goes through this, that kind of steps you through it, because I think it can be a little bit confusing, and that's where most questions come from. So let's look at another bright idea. So Jeff, I'm wondering, are you planning to pay for your Medicare premiums with your HSA? Is that when you're going to start drawing it down?
Come on, Jackie, what do you think? Come on, you know me. We have never met personally. What do you think I'm going to do? What do you think is going to be completely different and not norm?
Yeah, I think you are. You can pay for what part?
No. He wants growth.
I'm not going to use it to pay the B and the D. Not going to. Going to let it grow on until I'm 80.
Until you're 80. Well, that's optimistic. And you know what? You'll probably live until you're 100. So. Well,
my dad made it to 93.
So that's your drawdown strategy. You want to use it in your much later years.
Yeah, when your body is just like any other use asset, like a car or a house. It wears out no matter what you do and how well you take care of it. And I know as sure as the sun's going to rise tomorrow, I will be needing health care when I'm in my 80s.
So you're looking at it as like self-funding your long-term care insurance, right?
You got it. But okay. I've been told by other financial planners, don't use the HSA for long-term care. Go for, what is it on the taxes? If you're if you spend 7.5% on healthcare, you can get a deduction basically or something.
That's a good point. The other thing is that the long-term care premiums, it's not that big a deal in my mind, only because using your HSA dollars to pay long-term care premiums, because long-term care premiums are deductible to a certain extent already. So having the HSA make it tax deductible is not necessarily anything that you might not be able to get a different way. So
yeah, I'm going to be paying my Medicare out of my IRA and letting my Social Security build till age 70.
Gotcha. So you got that drawdown plan all taken care of.
I got it all written down through the ages. Yeah, and then let my Social Security build till age 70 and start drawing down. That's one of the reasons why I'm going to do my term IRA to HSA conversions or distribution, because my IRA by my income standard just shot over 655,000, like it was standing still. And I know someday it'll be approaching $1 million, $1.5 million when I'm in.
All right.
Yeah. So that's why I'm going to take a little air out of the tires, out of the account.
There you go.
I like that analogy. I like it.
But
I mean,
anyways,
this reminds our audience that if Jeff York was a financial advisor, you would want to use him because he's got this drawdown strategy and HSA tips and tricks down.
Yeah, and I have one more bright idea, you guys, and who kind of inspired this a little bit, Bill. We had Chris Golick on the show, and she's all about a smile and a suitcase and a smile, where she is a nomad. She's traveling all over the place internationally. So this is inspired by her. You can use your HSA funds abroad, think medical or dental tourism, if the procedure or the care is legal in both the U.S. and the foreign country. It just does not include where you can purchase drugs and have it shipped to the U.S., but you can be in Bali. You could be in Thailand and get a legal procedure done. Let's say I've heard about these places where you can go and get your annual workups at these places abroad, and they give you this hotel-like place to stay in. Or if you have this dental work that you need done, a lot of people I've heard you can get it done much cheaper in another country. You can use your HSA dollars for that, as long as it's legal in both countries. Now, that's a little known fact that I hadn't heard about. And I think there was a dentist or a doctor that did that. And he shared his whole story about how much he saved by being in the other country and the fact that he's used his HSA dollars to pay for the cost and the expenses, which made it even cheaper and tax-free. So
yeah, he's doing a geographical arbitrage on his healthcare. He's using his tax deduction and doubling up by going out of another country where that healthcare is a lot cheaper, is what he's doing.
I guess you could get international health insurance and pay your premiums with your HSA, right?
Yep.
I don't know if you could pay your premiums with your HSA dollars, because generally you can't use your HSA dollars for premiums unless it's Medicare premiums, COBRA, while you're getting unemployment and things like that. So I don't think you could. I'd have to double check on that, though. But good idea. We're thinkers around here.
I'm sure Jackie will get it down. And guys, we got to all encourage Jackie to write a book on this, because this would sell like hotcakes. A little booklet on this. All the HR people in the country would want it. You have to, and all the people that are on these plans would want it. So Jackie, yes, this presentation is important, but we want a book with your name on it.
I do need to write that book.
Yeah, you need another project, Jackie.
Now, yeah, exactly. Well, on that note, we're going to take a little break and we'll be right back. So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. So our social media is Diana Falk, our editor, Fritz Bassard, and show notes are done by Sarah von Sternberg. We love them and they keep us going.
Yeah, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you want to support the show and what we're doing, you can do that at Buy Me a Coffee, which is a platform that allows you to virtually say thank you if you get value from our content. The link is in the show notes, or you can head over to our website at catchinguptofy.com and click on the Support the Podcast tab at the top right. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could leave us a 5-star review so that our message can reach others.
While we are financial educators, and I'm a financial professional that loves to teach, our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
We'll see you next time on Catching Up to Fi.